Good morning. We have the next 15 minutes for me to share with you what has happened in equities, both in the local market and from an offshore perspective. I'm going to break this conversation down into 4 parts. Part 1, I'm going to have a look at what happened in SA equities in the last 12 months and what happened from a global perspective. What are the stories? What are the themes? Part 2, I'm going to have a look at what happened in the equity markets that were tracking the capped SWIX index fund as a benchmark, and what happened in the local market where we were tracking the JSE All Share Index. Third part, we're going to have a look at, was there value being created by active equity management in our SA markets? And finally, how did the momentum smart beta funds perform during these markets? Let's recap what's happened in markets in the last 12 months. I think we would all agree what we've seen in our markets in the last 24 months has been something very, very unique. Something I have never seen in my career before, and to be perfectly honest, something I hope I never ever see again. If we start with local equities on the left-hand side of this graph, shown in blue, we can see that the capped SWIX index had a very strong year, with SA equities up around 27% for last year. And the sectors all showing strong returns. Resources, industrials, financials, and even property, strong year for 2021. In the fixed income space, inflation-linked bonds was the place to be, with that asset class up around 16% for last year, and cash showing the worst returns in many years, where investors invested in cash only had a return of around 4%. If we look at precious metals and at oil, I think if we think back, at the start of COVID, oil went as low as $18 a barrel in March, April of 2020. And many of us might even recall that oil futures went negative. Something that's mathematically possible, but something I certainly haven't seen very frequently. On the gold side, gold had a very slow year last year, not surprisingly, but gold performed extremely well during the start of COVID, exactly as one would have expected. And on the platinum side, platinum actually had a very good start to 2021 in the first 4 months, but it came under enormous pressure in the back end of last year as there were concerns from the Fed around possible rate hikes and supply concerns on the chip side, which I even managed to experience firsthand when I ordered a new laptop in November last year, and it took nearly 3 months for me to get that laptop. On a more global perspective, strong returns from the various offshore equity side. If we start with the S&P 500, that market was up nearly 39% for last year, but it really was a FANG stock issue. Facebook, Alphabet, Netflix, and Google performing extremely strongly, and some of our pharmaceutical stocks. The interesting point to note, though, was how the more developed equity markets performed compared to our EM markets. On the DM side, we saw strong returns, 31% from our more developed markets. But on the emerging market side, you only earned around 4%. Again, showing the need to be well diversified in this space. And the rand slightly weaker, as we saw, about 9% weaker for 2021. If we look at it over a 3-year perspective, pretty decent returns. I mean, you earned around 11% per annum from SA equities in the last 3 years. Financials weren't great. If you were invested in banks, insurance companies, or medical schemes, you only got a return of around 1.5% for the last 3 years. Resources doing great, and properties having a negative returns. Fixed income, all looking good, and gold, interestingly, outperforming SA equities over the last 3 years. And from a global perspective, everything looking great. Strong returns pretty much regardless of where you had your funds invested globally. If we take that through to a 5-year view, pretty modest absolute returns in the sense that we only got around 7% returns from SA equities in the last 5 years. You can see financials still actually struggling, and the real star there being our resource sectors. And if you want to pick one share that actually tells that resource story, have a look at Anglo's. I remember distinctly when I joined Momentum in January 2016, the market was a little bit skittish, and the Anglo share price actually dipped down to around 55 Rand per share. When I checked yesterday, that share price was over 800 Rand a share. A great, great commodity super cycle. If you look at gold, gold also outperforming SA equities over the last 3 years, and from a global perspective, strong returns if you had your money invested offshore. Interesting to note that in Rand adjusted terms, you actually got more than double the return if had you been invested in the S&P 500 as opposed to being invested in local equities. This is a great slide that we'd like to look at in terms of trying to understand where did the market returns come from last year? So the 27% return that we saw in CapSwix, if you look at the far right-hand side of the graph, the big blue pillar shows the 27% return that we got from CapSwix. What we're then showing in the various yellow bars is what shares positively contributed to that 27%, and in the red bars, what shares took away from that market return. On the left-hand side, you can see that shares that actually contributed to that return, MTN, Anglo, Sasol, Richemont, FirstRand, all shares that you see in the top 5 of both CapSwix and AllShare. The interesting story to me is on the right-hand side. What shares took away from market returns in 2021? And there we see Naspers. Naspers actually pulled the market down by nearly 2%. And fascinating to me that in a year like last year, where SA equities were up around 27%, Naspers was in fact down 20% for calendar year 2021. And Process not featuring that much better. A very big difference to what we've seen in recent years, where Naspers has actually been running and pulling the market up with it. A key point for us to just reflect on is the whole concept of what is the equity benchmark of the funds that we choose to invest in. And what I'm comparing on this slide is how has CapSwix performed relative to JSE AllShare. So just to remind ourselves, CapSwix was actually brought about because 5 or 6 years ago, we were really concerned about the large concentration limits in 2 shares. At that particular point, Naspers, which was around 15% of the market, and SAB, which was prior to the actual unbundling that later took place, also at around 10%. And what the CapSwix says is no share can be more than 10% of the market benchmark in its particular market index. And what it's showing on this graph is that had you invested 100 Rand in the market 5 years ago into an SA equity fund where the benchmark was CapSwix, you would have got a return of around 42% over the last 5 years if that equity fund had given you exactly what it was trying to track. The red graph shows what would have happened had you invested into a SA equity fund where the benchmark was JSE AllShare. And in that case, you would have got a return of 71% over the last 5 years. Now that's a massive difference, right, between what CapSwix would have given you compared to what the JSE AllShare has given you. And it's a strong reminder to all of us that if you're going to go and compare 2 different equity funds, make sure you understand what is the benchmark of that particular SA equity fund. Because if you look at those 2 graphs, you would quickly think, well, this particular red asset manager has done far better than the blue asset manager in the last 5 years. But in fact, they've given you exactly what each of their particular benchmarks was. So when you're going to compare funds, make sure you understand what their benchmark was, because you can make significantly wrong decisions around which manager actually has skill and which manager doesn't. The third topic we're going to look at is there value being created by active equity managers for clients in the SA equity space? And this is a graph we showed before where we look at, on a rolling 12-month basis, on average, are SA equity funds that are being actively managed, are they capable of beating the market benchmark, or are they capable of beating the market on average? So what the graph shows you is if the yellow pillars are above the x-axis, on average, active equity funds are adding value for clients. They're managing to beat the market benchmark or beat a normal index fund. And what it shows quite clearly is that in the last 5 years, it's been the time to be invested in active equity mandates. But it also shows us that there are significant periods in time when active managers struggle to beat the market or beat the benchmark consistently. So there's always place for index funds in how we think about portfolio construction. What it doesn't show you as easily, though, is that as of the end of December last year, there were around 164 SA equity funds with a 1-year track record. And on average, had you bought all 164 funds, you would have beaten the market by around 0.5%. So there's value being created. But the best equity fund last year gave clients a return of around 60%. The worst equity fund last year gave clients a return of 4%. So while the average managed to beat the market, there's a huge range between the best and the worst. So while there's value to be had investing actively, your manager selection process is absolutely vital. And that's where your retail DFMs, your institutional DFMs and multi-managers have a huge role to play in choosing the correct equity funds for you to invest in. On the property side, a very similar story to what we showed last time. consistently through time, there's better value for clients to be invested in actively managed property funds as opposed to buying a more passively or a market tracking property index fund. Consistently, there's value being added for clients in the active space. So how do we bring it together? What do we think about? Well, I just mentioned there were 164 funds at the end of last year with a 1-year track record. So when you think about building out your SA equity building block, clearly you have a big universe of active managers that you can go and choose from, all trying to create value for clients, trying to beat the market in different ways, through their process, through their philosophy, be it a growth house, a value house, a sort of quality house, it really doesn't matter. On the other side of the market, you've got your passive index funds, such as the Momentum Capped Swix Index Fund. You'll buy the market fund, no chance have I bought the wrong manager, I'm going to get the market very, very cheap on fees. And then you've got your smart beta funds, somewhere in between those two styles. If you look at a time series of their fund returns through time, you would really quickly come to a conclusion that thinks this is a very good active manager. But in fact, it's a smart beta fund. It's a systematic process that tries to beat the market consistently, but in a way slightly differently to what your normal active managers are actually doing. And the trick to win this game in SA equities is to have a well-diversified exposure to all three of those. Have a mix of different active funds, have some passive exposure in that mix, and include smart beta funds as a way to get active equity exposure, but not having to invest into a more actively managed mandate. So how have the Momentum funds done? The final part of our chat this morning. The Momentum Smart Beta Fund, would you believe, now has a 5-year track record as of the end of March 2022. And as you can see on the graph, we're showing how that fund has performed in red relative to the Capped Swix index over the last 5 years. And it's had an exceptionally good run. It's managed to beat the market consistently by around 6.5% per annum over the last 5 years. A great way to get access to the market beating performance, but in a smart beta building block. And the Momentum Value Fund is also going to have a 5-year track record at the end of this month, and also managing to beat the market consistently, as you can see, by around 5.5% per annum since it was launched nearly 5 years ago. One question I've been asked, as you can imagine, very frequently in the last week or so is, how have these funds performed in the context of what's happening with Russia and Ukraine? And a really simple example to that is if I look at a share such as Mondi, which if you've been watching Mondi, has come under huge pressure in the last week because of its exposure that it has in Russia. But interestingly, Mondi as a share didn't find its way into either of our two smart beta funds. Why? In terms of how we filter out and how we assess whether shares are worthy of finding their place into our trending fund or into our value smart beta fund, it didn't tick the criteria. It didn't make the cut in terms of how we actually screen shares. And then when we overlaid our ESG filtering process, it again didn't make that cut. So Mondi is a really good example that our process and our philosophy stood up, and that share didn't find its way into either of our two smart beta funds. But these two funds are fantastic building blocks for DFMs, institutional DFMs and asset consultants and multi-managers to include in client portfolios to gain clean access to these two styles. And the final slide I have for you is the Momentum Core Equity Fund, which is available as a mix of everything I've spoken about. So it's effectively a blend of a Capped Swix fund and our 3 smart betas. So it's a blend of those 3 strategies plus the market. And as you can see, also has a 5-year track record at the end of March, and again done exceptionally well relative to its peers and relative to the Capped Swix index. And all 3 of these funds, our core equity and our 2 smart beta funds and our quality fund that I haven't spoken about this morning, you can access them via Momentum Unit Trusts, Momentum Wealth, or for institutional clients through a policy or through a segregated mandate. Thank you.